Welcome to FXTech's weekly analysis. This is our deep dive into the GBP USD pair for the week of November 24th to 29th, 2025. We'll be breaking down the key market-moving events, analyzing the technical landscape, and providing a strategic outlook to help you navigate the week ahead. All data is compiled and prepared on November 30th. Let's get started. The British pound staged a remarkable comeback, rallying for 5 straight sessions to close the week on a high note. After touching a low of 1.2487, the pair surged through the 1.3200 barrier, driven by a combination of shifting expectations for a Federal Reserve rate cut and the details of the new UK budget. However, light trading volumes due to the US Thanksgiving holiday amplified volatility, and the pair is now facing a significant wall of resistance. The UK's autumn statement delivered a mixed bag for the pound. Chancellor Hunt announced that the government's fiscal headroom has doubled to £22 billion, providing a short-term boost. However, this was overshadowed by the Office for Budget Responsibility downgrading the 2026 growth forecast to just 1.4%. With the UK's tax burden set to hit a post-war high of 38% of GDP, long-term economic concerns are weighing on market sentiment, creating a complex picture for sterling. A key driver for GBP/USD is the growing divergence in central bank policy. In the US, softer economic data has markets aggressively pricing in Fed rate cuts. In contrast, the Bank of England, despite a recent cut, maintains a cautious and gradual approach, as stated by Governor Bailey. This policy gap, where the Fed is seen as more dovish, is currently providing a fundamental tailwind for the pound against the dollar, limiting its downside. The economic data from both sides of the Atlantic is painting a picture of a slowdown. In the United States, weaker than expected retail sales suggest consumer strength is waning, fueling bets on Fed easing. Meanwhile, in the UK, the manufacturing PMI has slipped back into contraction territory at 49.9, with falling new orders and foreign demand. This mutual weakness adds another layer of complexity, suggesting that any rallies could be fragile and data-dependent. From a technical standpoint, the path forward is all about a major resistance zone. The area between 1.3270 and 1.3350, which also contains the 200-day moving average, is the critical barrier bulls must overcome. While the RSI shows positive momentum, the daily pivot sits at 1.3240. Immediate support is found at 1.3200, but a break below could open the door to a much larger drop towards the 1.3000 psychological level. The battle at this resistance will define the next major trend. For short-term traders, the key tactical range is set between 1.3000 on the downside and 1.3350 on the upside. The psychological level of 1.3200 is the immediate pivot point to watch. Given the thin liquidity environment following the holiday week, traders should be prepared for heightened volatility and potential whipsaw price action. The immediate strategy focuses on whether the price can break and hold above 1.3270, or if it will fail at this level and test support back at 1.3200. Despite the impressive 5-day rally, the bigger picture for GBP/USD still carries a bearish tone. The long-term ascending trend line has been broken, and the recent move up is best viewed as a corrective recovery. Furthermore, a death cross has formed, with the 50-day moving average crossing below the 200-day average, a classic signal of potential long-term weakness. Until the pair can reclaim the major resistance zone around 1.3400, the path of least resistance remains to the downside. Let's consolidate the key levels that will guide our trading strategy. For bulls, the immediate hurdle is 1.3270. with a breakout targeting the major resistance at 1.3350. The daily pivot point is 1.3240. On the downside, 1.3200 is the first line of strong support. A failure to hold this level would expose the secondary floor at 1.3100 and ultimately the major long-term support at the 200-day moving average around 1.2800. These levels are your roadmap for the coming sessions. In conclusion, our strategic outlook is to position for continued volatility driven by central bank policy divergence. The Fed's dovish stance provides a fundamental reason to favor sterling on dips. Tactically, we are looking to buy near the 1.3200 support level. A sustained breakout above 1.3270 would confirm bullish momentum, opening the door to our primary target of 1.3350. However, given the holiday-thinned liquidity, traders must practice disciplined risk management. Thank you for watching. Subscribe for more insights from FXTech for more insights.